Hey everyone, and welcome back for another deep dive. You guys sent in SoFi's Q3 investor presentation.
Oh, yeah.
And let me tell you, it is a beast. So many numbers.
It's dense.
Yeah. So today we're going to break it all down for you
Absolutely.
and give you the need-to-know info on SoFi's performance.
Exactly.
But first,
Nah.
gotta love the disclaimer slide.
Right.
They take their numbers seriously over there.
For sure.
But no worries, we'll make it fun. Okay, so we'll hit the highlights first, then dive into how those loans are doing, break down the revenue, and finally peek into what SoFi is projecting for the rest of the year. Sound good?
Sounds like a plan.
All right, so right off the bat, member growth. Boom. 756,000 new members in Q3,
Wow.
bringing the total to nearly 9.4 million.
That's huge.
Huge is right. That's a 35% jump year over year. I mean, what does that tell you?
Well, it tells me SoFi's strategy is working, right? They're attracting people to their platform. That's super important in the fintech world, especially since they're trying to be the one-stop shop for, well, everything financial.
Makes sense. And speaking of attracting people, check this out. 1.1 million new product additions in Q3. Total products. Nearly 13.7 million.
That's amazing.
31% increase year over year.
Yeah.
Even bigger if we take out digital assets.
Which is important to do here, right? Because remember, SoFi moved their crypto services last year. So if we want to see how the core business is doing,
right,
got to focus on the non-crypto stuff. And the big winner, their financial services.
Oh, yeah.
33% year-over-year increase. 11.8 million products, actually 40% if you take out the digital assets piece.
So they're growing beyond just lending. Now, there was something in the presentation that really caught my eye there. Financial Services Productivity Loop.
The FSPL.
Yeah,
Okay.
the FSPL. What's the deal with that? How does it work, and why is it so important for their growth?
Well, it's all about getting people to use more than one SoFi product, right?
Right.
You're happy with your SoFi checking account, maybe you'll try their investment products or get a loan.
Yeah.
It creates these marketing efficiencies, and it just makes sense for the customer too, right? Everything's in one place.
Makes sense. Lower
Yes.
costs for SoFi, smoother experience for the customer, win-win. Okay, let's talk credit. Kind of how those loans are doing.
Of course.
The report really goes deep on their net cumulative losses, the NCL, especially for personal loans. What's the big takeaway there?
So the recent loans, the ones from like Q4 2022 to Q4 2023, they're doing as good as or even better than the loans from back in 2017.
Oh, wow.
Yeah, which is pretty impressive, because SoFi actually made it harder to get a loan back in like mid-2022.
Right.
Tighter credit standards. It seems to be working.
So they're managing risk well. They even called out the 2017 loans, right? Those ended up with almost 8% cumulative losses.
Yeah, and the fact that the recent loans are on a similar or even better track is a good sign.
Yeah, definitely. Now, if we zoom out and look at the overall NCL,
Okay.
so SoFi has originated, get this, $39 billion in loans from Q1 2020 to Q2 2024. 43% of that is still outstanding.
Wow.
Total losses so far, $1.4 billion.
So to hit that 8% loss rate across all those loans, the rest of the unpaid loans would need to have a 10.4% loss rate.
Which is,
A lot higher than what we're seeing right now.
okay, risk management seems to be working. Let's talk big picture financials now.
All right.
Q3 adjusted net revenue hit $689 million.
Big number,
Big number, and a 30% year-over-year increase. They even beat their own guidance.
which, gotta say, is always a good sign. Shows they're executing well.
Yeah, for sure. And their adjusted EBITDA, $186 million. That's a 27% margin. They're not just growing, they're making money.
Exactly.
Now, one thing that jumped out at me was the revenue breakdown by segment. Financial services and technology platform, they grew 64% year-over-year combined.
And now they're almost half of SoFi's total revenue, right?
49% to be exact.
Yep.
So what does that tell you? Are they shifting away from just being a lending company?
I think so, yeah. They're becoming this, multifaceted financial tech powerhouse.
I like it.
In Q3, financial services brought in $238 million. Tech platform got $102 million.
Lending's still the big dog, though, right?
Right, $391 million from lending. But that shift towards a more diverse revenue mix, that's a smart move.
It is, yeah. Makes them less vulnerable to, swings in the market.
Exactly.
Okay, so before we wrap up this part, let's talk about what SoFi's seeing for the rest of 2024. They gave some pretty detailed guidance, right?
Yeah, they did. And it's all about growth. More than 80% growth in financial services revenue compared to 2023. They're saying
Wow.
lending, they're expecting at least 100% of 2023's revenue. And for the tech platform, they're looking at like low to high teens growth. Across the board, they're expecting to grow, which is,
Reinforces that whole diversification thing.
Exactly.
Okay, so bottom line, what numbers are they looking at overall?
So they're projecting adjusted net revenue to be between 2.54 and 2.55 billion for 2024.
Okay.
Adjusted EBITDA 640 to 645 million, net income 204 to 206 million,
Wow.
and earnings per share between 11 and 12 cents.
Those are some big targets, but it seems like they're on track.
Yeah, they do. Oh, and one more thing. They're expecting to add at least 2.3 million new members this year.
Wow.
That's a 30% increase from last year. Clearly, they're feeling confident.
All right. That was a lot of information.
Yeah.
I need a minute to process all that. We'll be right back to dive into some of the finer points of SoFi's performance. Stick around.
All right, so we're back and ready to get a little deeper into the details.
Yeah, those were some big numbers we threw around in the first part. Now let's dig into some of the finer points.
Exactly.
So one thing that often comes up, especially with these kinds of reports, is the use of, those non-GAAP financial measures.
Right.
Remember that disclaimer slide?
Oh, yeah.
They're really emphasizing transparency. This is where it gets important.
It is.
Can you break it down for us? What are these non-GAAP measures and why does SoFi use them?
Sure. So basically, non-GAAP measures are financial metrics that don't follow the standard accounting rules, the GAAP.
Okay.
Public companies have to report using GAAP, but they can also give you these extra non-GAAP numbers to give you like a different perspective on how they're doing.
So they're not hiding anything. They're just providing more context.
Exactly.
SoFi uses things like adjusted net revenue and adjusted EBITs,
Right.
which take out things like stock-based compensation or one-time charges. They say this makes it easier to compare their performance like across different time periods and to other companies.
It's like trying to level the playing field,
I get it, but I know some people are wary of these non-GAAP numbers. What are the potential downsides?
Well, yeah. I mean, some critics say these non-GAAP measures can be like manipulated to make things look better than they actually are compared to the GAAP numbers. So it's always smart to look at both the GAAP and the non-GAAP.
Compare and contrast.
Exactly. And try to understand why they're making those adjustments.
Okay, so a little healthy skepticism is always good when it comes to numbers.
Yeah.
Now let's talk Galileo, SoFi's technology platform that provides services to other financial institutions.
Right. Galileo. It's a big part of their story, but sometimes it gets overshadowed. They're not just serving their own members, they're powering other fintech companies behind the scenes.
Right, they're the engine under the hood.
Exactly.
So what stood out to you about Galileo in this report?
Well, their reach is just massive. Galileo accounts hit 160 million.
Whoa.
That's a 17% increase year over year.
That's a lot of accounts.
It is, yeah. It shows there's real demand for their technology.
SoFi is not just a consumer brand. They're becoming like a major infrastructure player in the whole financial services world.
Right, like the Intel inside of fintech.
Love that analogy.
Okay.
Back to the core lending business for a sec. Let's talk about net interest margin, NIM.
Okay.
This is a crucial metric for any bank, right?
Yeah, NI is basically the difference between the interest income a bank earns on its loans and the interest it pays out on deposits. It's all about efficiency, how well they're managing their money.
So higher NIM generally means more profit from lending.
Right, exactly. They're earning a good spread between what they charge borrowers and what they pay depositors.
Now, SoFi's NIM has been kind of up and down lately.
Yeah.
It's actually a bit lower in Q3 2024 compared to Q2. What's going on there?
Well, a few things. Interest rates, for one.
Right.
Rates have been going up, which means it costs banks more to borrow money. That puts pressure on their margins.
Oh, yeah.
And then there's competition.
Yeah, the fintech lending space is getting crowded.
It is. And that competition can drive down interest rates on loans, which again can squeeze that NIM.
A delicate balance.
It is. So SoFi wants to offer competitive rates to attract borrowers, but they also need to make sure they're making money.
Definitely. Speaking of loans, the report also mentions the fair value of SoFi's loans.
Right.
What does that even mean, and why should we care?
So the fair value of a loan portfolio is basically its estimated market value. It takes into account things like interest rates, credit risk, how likely borrowers are to prepay their loans. It's a way to gauge how the market views those loans in terms of their quality and risk.
So it's like What those loans would be worth if they were sold today.
Exactly. And what's interesting is that the fair value of SoFi's personal loan portfolio has gone way up year over year. It's over $17 billion now in Q3 2024.
That's a good sign.
It is, yeah. It suggests the market sees their personal loans as valuable and likely to perform well.
Positive signal. But we also need to look at this fair value thing alongside other credit performance indicators, right? Like delinquency rates.
Absolutely. You want to see the whole picture.
It SoFi's delinquency rates, especially for loans that are really late, like 90 days or more, they've stayed pretty stable.
Even improved a bit recently.
So they're managing credit risk well.
Seems like it.
They're growing, making money, and keeping those bad loans in check. Pretty impressive.
It is. They're navigating this economic environment well.
All right, we've covered a lot of ground here. Ready to move on to the final part and talk about SoFi's future.
Absolutely. Let's wrap things up and see what's on the horizon for SoFi.
Okay, we're back for the final part of our SoFi deep dive. We've talked about their growth, their revenue mix, and how those loans are performing. It's been a pretty impressive picture so far, right?
Yeah, definitely. Lots of positive signals from SoFi.
So the big question is, what's next for SoFi? Where do they go from here? Are they set up for continued success, or are there some bumps in the road we should be thinking about?
Well, predicting the future is always tough.
Yeah.
But based on what we've seen so far, I think SoFi's in a great spot.
Why do you say that?
Well, first of all, their growth is incredible. New members, new products, it's just booming. And their guidance suggests that's going to continue.
Right.
But it's not just luck, it's strategic. That financial services productivity loop we talked about.
The FSPL.
Yeah, that's a big driver.
Getting people to use more and more SoFi products.
Right. Builds loyalty, increases revenue per customer, lowers their acquisition costs in the long run.
Smart strategy.
It is. And then you've got their diversification.
Right. They're not just about loans anymore.
Exactly. They're becoming a full-fledged financial platform. Banking, investing, insurance, student loan refinancing, the whole shebang.
Makes them less reliant on any one product.
Right, exactly. More stable, less vulnerable to market shifts.
So they're on the right track. Strong strategy, solid execution. But are there any challenges, any risks that could trip them up?
Well, there's always competition, right? The fintech world is moving fast, new players popping up all the time.
Got to stay ahead of the game.
They do. And then, we talked about those rising interest rates. That could keep putting pressure on their net interest margin, their profitability.
Yeah, definitely something to keep an eye on.
For sure. They need to manage their lending and their funding costs carefully to maintain those margins.
Sounds like a balancing act.
It is, yeah. But from what we've seen in Q3 and what they're projecting,
seems like they're up to the challenge.
I think so. They've got strong leadership, a clear vision, and they're clearly committed to innovating. I'm excited to see where they go from here.
Me too. This deep dive has been really insightful. SoFi is definitely a company to watch. There's no doubt about that. But before we sign off, I want to leave our listeners with a question to ponder. SoFi's growing fast. They're diversifying. They're shaking things up. What does this mean for the old guard, the traditional financial institutions? Can they keep up with these nimble fintech disruptors? Or are we seeing a fundamental change in how we bank and manage our money?
That's a great question. I think we're at a turning point. Technology is changing everything.
It is.
Traditional banks, they need to step up their game, embrace innovation, meet those changing customer expectations, or they're going to be left behind.
Right. And for our listeners out there, I encourage you to check out SoFi's products, see what they have to offer. You might be surprised.
Yeah, definitely worth a look. They're doing some really interesting things.
All right. Well, that's a wrap for our SoFi Q3 deep dive. Thanks for joining us.
Always a pleasure. And as always, if you have any questions, anything you want us to explore in future deep dives, let us know. We love digging into the data with you.
Until next time, happy investing.